In this video, we are going to compare ASX200 ETF provided by Blackrocks iShares with the ticker code IOZ with Vanguard version of Australian shares ETF with the ticker code VAS. Blackrocks iShares ASX200 is also known as Aussie Top 200. I'm not trying to sell you ComSec Pocket or these two ETF, but trying to give you informational video and hopefully educational for some people, because the idea of investing with index funds, for example ASX200 according to S&P Standard & Poor's index, is basically saying that the investor don't know enough of who's the winner out of these 200 companies, and they just want to invest on the whole thing based on market capitalization. And what we're going to compare between BlackRock's IOZ and Vanguard VAS is that the underlying companies, the business that you're investing in, so the 200 business as opposed to about 295 or 297 from Vanguard VAS. Because both ETF have similarities. For example, the management fee for BlackRock's IOZ is about 0.09% per year, and Vanguard VAS is about 0.1% per year. However, they both follow a different index. BlackRock's iShares IOZ follows S&P ASX200, whereas Vanguard VAS follow S&P ASX300. And according to their website, that BlackRock's IOZ has achieved returns since inception about 7.6% per year, and Vanguard VAS has returned since inception about 8.8% per year. I'm not saying this ETF is better than the other, I'm just giving you the information. So basically what I did, I download both of the total holdings for each ETF and basically compare them. Both ETF index are provided by S&P Standard & Poor's. One is covering the top 200 companies in ASX and the other is the top 300 companies in ASX. So does the difference matter? The 97 companies that is not included in IOZ of ASX200, does it matter? And if so, what are the difference? So, like I said, I go through all the underlying companies and look at the following metrics: the market capitalization, the total asset, the net asset, the revenue they generate, and also the net profit after tax. And I added the dividends paid as well, so that it gives you a feel whether these 97 companies that is not included in ASX200, do they give a lot of impact in the dividends paid out to the investor. So all of this data based on the data of financial year 2021 annual reports. Yes, I go through about 300 of them, but the accuracy is not guaranteed. It's just to give you a general idea of the comparison on the differences. And also the market capitalization is based on the share price around August 2021. It's not gonna be 100% accurate, but it's pretty close enough. So let's start with the market capitalization. What I found is that the total market capitalization for the top ASX200 companies combined is about $2.7 trillion. Whereas the top 300 companies or top 297 companies is about $2.8 trillion. So the difference is about $119 billion. So the 97 companies addition included in Vanguard VAS adds in about market capitalization about 119, which is not much, but still significant. This is due to the nature of the index, that is market cap weight. So the bigger the market cap, the bigger portion of that particular company's stocks to be held in that ETF. For example, obviously the biggest one will be BHP, CBA, and CSL, and obviously they will have more weight, just like shown in this Vanguard slide. So about 9.2% for BHP, 8.1% for CBA, and 6.6% for CSL. This is because their market capitalization is so big. Let's skip to the revenue and the net profit after tax. The top 200 companies of ASX based on financial year 2021 results has a total revenue of about $1.03 trillion. Whereas the top 300 companies has a revenue about $1.08 trillion. So the difference is about $48.8 billion. So the 97 companies that is not included in ASX200 ETF contributes about $48 billion. It's just to show that based on 2021 results, the bigger the market capitalization of a company is, the more profitable they are. And if we look at the net profit after tax difference as well between the ASX300 and ASX200 ETF, the 97 companies not included in IOZ contributes about $1.7 billion of net profit, which also implies some of them are not profitable yet and may report a net loss. And obviously with the net profit after tax total differences are minimal, the total dividends paid to the shareholders also minimal. So for example, the top 200 companies in ASX200 ETF paid out about 93 billion Australian dollars of dividends, and the total 300 companies paid out the dividends about $94 billion. And lastly, the income tax that this company reported for the top ASX 200 companies for 2021 is about $60.6 billion. Whereas the total income tax reported for ASX300 companies is about $60.607 billion. The difference is very, very minimal of just $6.6 million, which means a lot of the 97 companies not included in ASX200 ETF, but it is included in ASX300, for example, Vanguard VAS. Some of them are not profitable, or they may receive some sort of tax benefit. I'm not saying one ETF is better than the other. I'm not allowed to do that kind of thing, but I'm just sharing with you the similarities and the differences between the two and focusing on the business. If we do a comparison between market capitalization and the profit after tax, pretty close to price to earning ratio, we have total market capitalization for ASX200 ETF about 2.7 trillion and the total profit after tax about $152.9 billion. That is a PE ratio about 18. And interestingly, the ratio is similar for ASX300 ETF as well with VAS. It's also about 18. But the slight difference is on the market cap to dividend ratio for financial year 2021. Because like I said, maybe the 97 companies, they are not profitable during that financial year. And that's it for today, guys. Notice that I didn't put portfolio weightings for each stock because otherwise it becomes focusing more on the valuation and that becomes a financial advice. I just want to share with you and give you some educational content about, wow, if we buy the top 200 companies, we're essentially getting a piece of that profit of, say, $152 billion and the dividends of $93 billion being paid out in 2021. But the future, I don't know so much. And to be quite frank, nobody knows. Thank you.